Hi, everyone, and welcome. We'll be getting started in just a few minutes as we give everyone a chance to join. In the meantime, if you have any questions for our speakers throughout the presentation, please feel free to submit them in the chat. Welcome, everyone, and thank you for joining us today at Money Show's virtual event, Investing in Alternatives. It's now my pleasure to introduce our speakers, Luke Lloyd, founder and CEO of Lloyd Financial Group, and Colin Simons, the firm's chief investment officer. Luke founded Lloyd Financial Group with a client-first approach centered on transparency and accessibility. Colin brings more than 25 years of investment management experience and leads the firm's investment strategy, portfolio management, and market research. Together, they combine decades of experience to help investors navigate today's markets with disciplined, research-driven strategies. Let's welcome Luke Lloyd and Colin Simons.
Thank you, Madison. I appreciate that. Thanks for everyone for coming today. It wasn't that long ago, I think a few months ago, that me and Colin were down in Florida speaking at one of the events. So maybe you saw us in person there. And some of the conversation today is going to be very similar to kind of what we said on stage. It was actually a very good call at the time, talking about rotation into software. I think 2 weeks after we spoke, or a month after we spoke down in Florida, like in May, we saw a lot of rotation into software names. And IGV was trading, I think, at $78 when we were talking, Colin, if I remember correctly, probably down in Florida. IGV got up to 110, 105, and a lot of the names we were talking about rallied pretty hard since then. So we think a lot of that rotation is going to continue. We'll get into some of that today throughout the presentation, but just a high level, I'm going to go through again who we are, why we do what we do. I started Lloyd Financial Group. Very thankful in my life. I had really good mentors in a lot of ways. Colin actually sold his firm to my previous firm, and that's how we met. And Colin and I, it's great yin and yang. One thing I promise all clients is, first class service, communication, really in depth financial planning. We have a tax CPA on staff that we does all our clients' tax returns, takes a look at. Yeah, we had someone reach out yesterday that's interested. They have a lot of SpaceX stock, a large chunk of it. They're wondering how to unwind that from a tax standpoint. We're going to help out with that case. So it's not just the investment side. That's the fun, sexy part that we always talk about. But there's a lot of other stuff we try to do at Lloyd Financial Group. And Colin, with his experience, Colin, you want to go through a little bit about what you do, why you do what you do, and where you've been?
Yeah, I've been a portfolio manager. I was the CIO of my previous firm since 2000. So I've been doing it a while. And before that I was a software programmer. And what I discovered with that, I ended up doing database warehousing as a computer programmer. And what I enjoyed was the puzzle. I mean, I did database warehousing before it was really a thing. I read a book on the theory and helped make the system. And to me, that's what I personally enjoy about the stock market is it's a really hard puzzle that people are still trying to figure out. So yeah, that's what I enjoy, and I'm not big on relaxing. So I sold my one company and decided I want to keep doing this. So now here I am with Luke.
That's right. We partnered together, and we're going to be rocking and rolling. Talking about puzzle pieces and putting the puzzle together, we talk about the puzzle, the markets, macro economy, stock picks, all in our daily newsletter, which is why I have this slide up there. Lloyd Financial Group. It's called the LFG Daily. You can take your phone out, scan that QR code. It takes you directly to the newsletter. But every single day, Monday through Friday, 8 a.m. to your inbox, we talk about what's going on in our heads and our portfolios and what's going on in our life and our analysis every single day. So let's get into the meat and bones. And me and Colin are going to tag team this. And I'm basically just going to be asking probably Colin a lot of questions here because we've been making some interesting moves in our portfolio the past few weeks, and specifically the past 3 or 4 months, and specifically in software. So let's talk about software and let's talk about AI. What is the AI shift and what is coming on the horizon? It's not just about another product. It's a whole industry shift. What is AI? It's such a big macro term that everyone talks about. But really, at the end of the day, the way I think about AI is that every corporation is an AI company now. Kind of like the internet was created back, 30 years ago or came out. Everyone had access to it. All these businesses that started adopting it, come up with new marketing ideas, and implemented it into their business. So every company basically became a internet company. I see every company becoming an AI company to increase productivity. It's going to hit the bottom line. It's going to hit the margins, increase margins. It's going to reduce overhead. And specifically in software is already a very light overhead business. It's one of the reasons why software has done so well the past couple of decades. And a lot of these tech firms have done so well because their margins are so high, their growth so high, and the cost of doing business is not very high at all. So that mentality is just only going to increase as AI gets implemented. So Colin, what are your thoughts on implementation of AI? And there was this whole philosophy that AI was going to replace software. Like I could go on Claude or ChatGPT and code up my own tax software that's going to replace something like Intuit. What's your whole philosophy on AI hitting every single company and then get into software specifically?
Yeah, I mean, all this stuff is complicated in the details. So, you sit there with the idea that AI can eat software. And to me, the answer is kind of, sort of, but mostly not. So if you have a relatively simple software product, like, hey, we make it easier to design websites, that's relatively harder to defend because AI is going to make it easier to design websites. And once you're done designing your website, you're done with the company. If you're doing payroll for a company, that's going to be a whole lot harder. You have a whole ecosystem in there that AI, at least currently, cannot seem to reproduce. You never know what the future exactly is going to look like, but so far, most of the most of the software companies you're going to find in the market should have a moat. I mean, they are in a capitalist environment anyway, And so they have been under attack since they began. They've been under attack since they were growing. The idea that AI is the final nail in their coffin is probably pretty unlikely.
And that hits the valuation. And that's one of the reasons why I think software is so attractive is you take a look and everyone talks about the market being overvalued. And I bring up this point a lot. Historical earnings in the S&P 500 is about 6% earnings growth per year. I think it's projected in Q2 upcoming earnings season here in the next few weeks. We're expecting 24% or 23% earnings growth over year. That's 4 times the historical average. Then you take a look at the valuation on the market. I think the S&P is trading at 20 or 21 times forward earnings, which is about 30% maybe above historical future valuations of future PEs of 17 times. So you're basically paying a 30% multiple to have 4 times the historical earnings. That's pretty attractive to me. I can't believe we're actually not higher in a lot of ways. But then you get into software. A lot of the software names we've been adding, Colin, are trading at 16, 17 time forward PEs when a lot of these stocks are trading at 40 or 50 times forward PEs in 2021. A lot of these companies have very similar amounts of growth and profitability that they had in 2021, some even more. So why is it hitting the valuation so hard, and why is software just so unloved?
2 things. Number one, you just have the basic fear. So you have the story of AI is going to take over. And then, you do have these funds. There's a lot of long short funds out there, and they have tried to short software to go long semiconductors. And, right now, as we can see lately in the last week or so, especially, that's looking like a somewhat stressed trade. So I don't know, that's the basics, I guess.
So this was kind of the reason I have this slide up here is this is kind of where I see at least somewhat of a path, right? First it was semiconductors that rallied, and they still continue to rally a lot the past few years. A lot of it was cloud infrastructure plays. So now it's going to like photonics and quantum computing. You're seeing some of those plays tick up, or at least some iterations of them getting some strength. Software right now is unloved. Cybersecurity that is doing pretty well in some areas. One of the stocks we own is Fortinet, which has done pretty well. It's done a lot better, I think, than some of the other cybersecurity firms. But essentially, the semiconductor and cloud infrastructure, AI, data centers, the cloud, quantum computing, the photonics kind of plays that rallied. I think a lot of that money is going to transition into software and cybersecurity because it's going to be a mean reversion because of valuations. Do you agree with that, Colin?
Basically, yeah. I think for the last 2 or 3 years, especially, we have been doing a picks and shovels play. The market has been doing a picks and shovels play where it's, okay, we have to build out all this equipment. And what's the equipment? The equipment is semiconductors and to some extent cybersecurity. I mean, you have something like Fortinet. One of the reasons it's done so well is it's mostly hardware. You have a box in your server that is a Fortinet piece of equipment. And the question is, how long is that going to go on for, or are we going to move on to something else? Now we're starting to see signs of a rotation in the market. So you're seeing a whole lot of dispersion in terms of individual returns while the market kind of chops around. So, it is a little bit exciting right now.
Well, that's why I appreciate you sending this note to me earlier. I put this slide up. I was talking about picks and shovels and kind of our philosophy. And I want to be very specific here. All the stocks we mentioned here, we still own, but we trimmed Intel, we trimmed Teradyne, we trimmed Fortinet, frankly, because a lot of these positions became just so heavy in our portfolios. I mean, Intel quadrupled from our cost basis. Teradyne, I think, doubled. Fortinet, I think, almost doubled as well. I think it has over doubled from a cost basis position. So these stocks became very heavy weighted, but also this is part of our philosophy of the rotation out of the picks and shovels, out of some of the hardware, out of some of the semiconductor plays, and into things like Microsoft, Oracle, and CoreWeave, which we've been buying into. We actually added more Oracle last week, correct?
Right.
So tell me a little bit more about Microsoft, Oracle, and CoreWeave and the philosophy behind those three specifically.
Yeah, well, my hope is that that's the next stage. So one of the problems with something like Oracle, we have this fear, well, we don't, but the market has this fear that they are front loading all the spending. So people sit there and say, boy, you've destroyed your free cash flow because you have so much capital spending, and that's so different from what we're used to seeing in a software company. Well, to me, it's very asymmetric. Basically, if you think that Oracle is going to fail, you're very negative on the whole AI market. You think that the AI market is super overblown because what they have done is they have said, okay, we're going to spend all this money now, and over the next several years through 2030, we're going to make multiples on that spending. And I'm totally comfortable with that idea. Obviously, the market is not. And to some extent, you have the whole long short thing where there's this tendency of you have these funds where they are actively shorting software to buy semiconductors. So to me, Oracle is one of the most asymmetric bets out there. If you think that AI has a future, then Oracle numbers going forward should be enormous. They should set all-time highs in earnings by the time you hit like 2029, probably earlier, 2028.
Well, look what happened yesterday. Samsung's another great example. I think Samsung reported their earnings yesterday. 18 times profitability year over year, 1,800% growth. And then I think revenue is up like 40% or something like that. Insane amounts of growth in Samsung. But then the stock sold off 6% because they said they're going to spend $650 billion over the next 10 years investing in AI. That should get people excited. That should not be a negative. You should want a company to reinvest their money into the future. It's like the same thing as saying in 1996 or 1995, we're going to pour billions of dollars into the internet infrastructure and build out that to incorporate into our business. It probably was a good idea. It probably worked out pretty well, turning your business into an online business or adopting that in some sort of way from a marketing standpoint, whatever it be. So I think it's very similar to that kind of transition. And another kind of few names we've added. I think Economy Technologies is another one we added recently. Tell me a little bit about that one. And also Sony, I want to talk about, because a lot of people debate own semiconductors or software. I think Sony is about 50-50, 50% kind of semiconductor business, photonics, and 50% software. So if you want to play both, you can kind of own Sony.
Yeah, Akamai is actually our most recent buy. I think that was last week. And the reason with that is it has this, to try to explain it simply, it has this network that makes the internet more efficient. And as we devolve AI into, from training to being more effective, their traffic is likely to improve. So, as everything sort of gets more spread out, the need for an Akamai should go up quite a bit.
What about Sony? Tell me about Sony. We picked
Oh
that
yeah,
up. I think
Sony. I knew there was something else there. So Sony is pretty interesting. Obviously, it's a conglomerate, so it has a big media division. It has technology. It has the PlayStation 5, all that kind of stuff. There are two things that I like about that. Number one, it's kind of number one, it was cheap. So, you sit there, you look at the expectations, and the expectations they got very negative, and part of that was the idea that, oh, they have to pay for these memory costs. And my attitude is, okay, when you start pricing in that these costs are going to last forever, it gets pretty easy to flip and say, okay, maybe these memory costs are not going to go on forever. So as we start to see people say, oh, maybe memory isn't going to go up forever, then Sony starts to recover, which we have seen to some extent. It's
interesting how the market just seems so unloved in so many areas, and then once it becomes loved, it stays for a long time. Like, Nvidia was an easy play for years. I mean, you could have thought Nvidia was the pure play, and until it happened and sparked that rotation, it took a long time. But once it happened, it's off to the races, right?
Yeah. Yeah, and we don't worry about the short term, at least we try not to. Obviously, it's not a whole heck of a lot of fun, and we try to be diversified so that something is always working. But the short term, the short term lately has been super chaotic as the market is trying to find a safe space to go. So people all dive into one thing, then it dies, and then they try to dive into another thing, and then it dies, and so on. So that's why we try to be longer term oriented, which is why I like some of these next plays. So you get the Microsofts, the Oracles, all that kind of stuff, because to me, they have already gotten their bad news out of the way, and the long term still looks pretty darn good. So, when they hopefully, and I think they should, come in with increasingly strong earnings and capital spending relaxes, that should work out very well. And you were talking about how Nvidia has been enormously good. to me, that's my hope, is that the next stage is just going along the AI ladder. Instead of the picks and shovels, you're going to go towards the people who are buying those picks and shovels and turning it into a business.
Well, this first point here on kind of the risks of portfolio positioning, I mentioned high valuation in some leaders, and basically I'm referencing like the NVIDIAs of the world. It's not necessarily a risk, though. I think it's more of a positive because money is not created or destroyed, really. It's kind of transferred, right? It's kind of like energy. It's like Newton's one of his laws, right? Energy is not created nor destroyed. Money is not created or destroyed. Kind of is by the government. They print more money, so it kind of is created. But when it comes to market rotation and market transfer, higher valuations or higher, semiconductor plays that have rallied so much, that money will rotate somewhere. The question is, does it stay where it's at, or where does it rotate next? So we are picking, again, a lot of names in software. And this also heads into kind of 2 points I wanted to talk to you with, Colin. I'll give a high-level overview, but I want you to go into the details. You wrote in our newsletter a few days ago some great points about the U.S. dollar. So the U.S. dollar, I believe, is up 5 or 6%. Since January. We've seen the DXY dollar index above $100. I think it was down to 95 at one point. So we saw a weak dollar for a while. We saw a strengthening of the dollar because we went from 2 interest rate cuts at the beginning of this year to 2 interest rate hikes. But we think the dollar is probably topping at this point because inflation expectations are coming down. Oil prices, I think they're up today because maybe some reignition of conflict. But we think long-term oil prices will remain down. This Iran situation probably is not for sure figured out, but it's towards the end. So if oil remains below 70, inflation expectations come down. The Federal Reserve probably won't hike rates, in our opinion. They may even cut rates sometime this year. That's probably good for a weaker dollar. That's good for long duration stocks. That's good for a lot of these software names as well. So that's kind of a tailwind on the horizon, don't you think?
That's my expectation. And honestly, that goes down a whole chain. Some of the stuff starts to get kind of complicated, but we have seen the peak in oil, which indicates that there's a good chance that we have seen a peak in inflation. The last round of inflation numbers were pretty encouraging on that mark. People were afraid there'd be a high PC inflation number. That was better than expected, not by a lot, but by some. And the fear was that would be a huge number with the Iran war. And then you look at again, there's this whole ecosystem of determining where capital is getting treated best. So, right now, because of all the mess that we've seen over the last year, we see real rates very high, especially on a longer term basis, honestly all across the curve. But I think for the long term, looking at the long term real rates is important. Those are about as high as they've been in the last, I can't remember the number right now, but the last several years. What are the odds that that's going to go down as people relax on rate cuts? To me, it's likely. Once things start to hit an extreme, you have to start thinking, is that going to relax? And if that relaxes, that informs what you want to buy.
Those are all great points. So the takeaway summarizing, I know we got about 10 minutes left. I want to leave some room for Q&A, but I want to summarize kind of everything we're talking about. At the end of the day, there's a lot of noise out there. I think the noise creates some insanity when it comes to investing or thinking about investing. We try to simplify things. And 3 things we talk about every single day in our newsletter, the 3 things we track that really along the lines really dictates our portfolio is liquidity, growth, and inflation. So Colin, can you kind of hit on what those numbers are looking like right now and how we focus on those 3 to kind of try to tune out the noise just to get some pure data points on risk profiles for our portfolio?
Yeah, just to go down the list quickly, growth, inflation, liquidity. Growth has surprised people because for the last at least year and perhaps more like 2 years, people have been sitting there saying, oh, this has to slow down. And that was a reasonable belief because 2020 had enormous stimulus. So you were going on the downslope from there, and people tend to be linear thinkers. So they sat there and said, okay, well, we're going to just go down until we hit recession. So there were a lot of recession calls out there. What we're seeing in growth is that it's actually held up way better than people have thought. So we tend to target both the trend and are you above a reasonable level? And in this case, we're over that reasonable level. So if you look at some like 2 or 1.5% growth, we're still over that. Now, there are constant worries that we're going to dip below that, but growth is still holding up well, and it's holding up better than expected, which is important. Inflation, we've had a lot of inflation fears recently with the Iran war. A lot of those shorter term metrics peaked a while ago, and the longer term, the core PCE, all that kind of stuff, that's starting to fade down to reasonable levels. We're not there yet because it's acting sticky and that might not change. But while inflation is elevated and persistent, it hasn't represented much of a problem because that was so priced in. And then liquidity has been fantastic. One of the problems with that when you get, because it's been good for a while. So as you get this enormous leverage and credit growth, and it's also not just come from us. So Japan has been an enormous source of stimulus. So as that starts to potentially hit worrisome levels, and that's particularly true in Japan, I think that's part of the chaos that we're seeing here, where you just don't have infinite money. And Korea has turned into, well, they always kind of were degenerate gamblers, and with their stock market, they really pushed that up quickly. So that's why you're seeing some of the stress right now, and you're seeing some rotations. But in general, right now, from a long-term whole market basis, there's really not a whole lot to worry about. It looks good long term. You can get little chaos as people get out of semiconductors or who knows, but long term it looks pretty darn good.
I'm gonna get a little philosophical for about a minute, then we'll open up to questions. You know, when I think about the future, the next decade, whether it's AI or just overall how the system works, I see a world where there's potential where unemployment goes up because AI do think in the end is going to replace a lot of jobs. It's going to create a lot of new jobs. But I think in the immediate kind of initial, any kind of downturn, people are going to get laid off, people are going to implement AI. And I think that unemployment systematically is going to go up. But my point is this whole thing is usually the governments learn the playbook. The governments learn the playbook when crap hits the fan, lower interest rates, bail things out, print more money, put a band-aid on it. That's what they did during COVID when they printed trillions of dollars and lowered rates, and we had this massive stimulus, all this money sloshing around, record M2 money supply like we're seeing now. They just still haven't stopped spending. I also see a world where if AI starts replacing jobs and it becomes political, it doesn't matter if you're a D or R, it seems like both parties are now okay with giving out free money. Trump was just talking about tariff checks. And I know this didn't happen, but it seems like that mentality is there. I see a world where UBI is right around the corner, universal basic income. So if AI starts replacing jobs, government hands out even more money to people. They go spend it more on corporations. So even if you don't have jobs, you're still making money from the government. You're still spending money. So I see a world where we go through the biggest wealth separation, I call it, in history over the next, we've already seen it the past really 6 years. We've seen it the past 15 years in a lot of ways where that middle class is separating. I think the wealthy, those that own things, real estate, maybe not is my least favorite because we do have population collapse probably happening in 2050. The real estate's a Ponzi scheme. We need more people filling houses, and we're building a lot of houses right now. But all other asset classes, the market, companies, I think that will continue to do well over the next 30 or 40 years. And I kind of put my money where my mouth is. That's why I started Lloyd Financial Group in a lot of ways. I wasn't born into legacy money. But if I can help people make a lot of money with Colin's brains of being able to come in with a good investment strategy, we're going to make a lot of money for clients, and I get to partake in that wealth separation. So I kind of put my money where my mouth is there. I truly believe that's the world we're entering over the next 30 or 40 years. And Ray Dalio talks about it a lot. The big, Roman Empire, Dutch Empire, British Empire, after 250 years, and we just hit that mark just a few days ago, some interesting things start happening in the nation, inflationary issues, government involvement, overregulation, transition to socialism. And most people think that's a horrible, bad thing, and it is. It is a bad thing, but it's not bad for those with money. Those with money actually tend to make more money. So I think we're seeing a lot of that happening. I'll finish it with that kind of philosophy. We'll open it up to questions. I'll put up the daily newsletter we write about. My philosophy kind of goes into some of that stuff I talk about. Colin writes the middle of the bottom portion where he talks about investments. I talk about financial planning and tax planning at the top. Give that a subscribe with your phone. It goes directly to the newsletter.
All right, for some questions, is AI creating real earnings growth, or is the market pricing in too much too soon?
I think it's immediately adding some value already. I mean, every business I know is implementing it. I mean, I know I use AI every single day at Lloyd Financial Group. If I'm using it, with our small business, I can't imagine what these big companies are using it for. So I think it's adding immediate value. It's already here. Colin, you can probably get in some of the nitty-gritty details.
Yeah, AI is entering the numbers. We are seeing earnings be positively impacted by AI. You always have the question there of to what extent is that priced in, which is part of why, to beat our own drum, I like the differential we're going on because people are looking at the spending some like software companies are doing and saying, well, we don't like all that spending, even though their earnings are growing. You have something like the semiconductor industry, and the expectations have been priced in quite a bit. So, to me, it is in the numbers, and I think that that's going to increasingly help the assumptions in software, whereas in hardware, the expectations are already so high, that's a relatively tough to beat number.
Yeah, I'd say it's already here, and it's not really being priced in a lot of areas. Outside of semiconductors and hardware, there's probably 80 other percent of other areas of technology that's not pricing this in. So, and even outside of technology stocks, again, every company is becoming an AI company, and that's not being priced in all the other 493 stocks in the S&P 500 in a lot of ways. So that's why the RSP, I think, is a good equal weight is a good way to play the market right now.
And will AI create more opportunities for software companies or disrupt them?
Colin, you want to start?
Yeah, I didn't catch the end of that question. What was the last part?
Will AI create more opportunities for software companies or will it disrupt them?
Oh, yeah, and that's certainly the worry. The worry is that they get disrupted. And again, I do think that there is there's some differentials in there. I don't think you can just buy every single semiconductor name. So, for instance, the one company I was referring to earlier is Wix. Wix makes websites for people. And unfortunately, that seems like a pretty easily challenged business. On the flip side, just to look at something that hits the news now, I mean, people have talked about ServiceNow and Salesforce and all that kind of stuff. Those guys have massive moats, and those guys are actively using AI in their business, and they're getting additional attachment using that. So I think the disruption is very unequal. And again, the fact of the matter is these software companies have been battling in a capitalist system for years. AI is just another thing. So somebody like Salesforce or ServiceNow will sit there and say, okay, we can use this to make us better than the other guy. So you have it's the whole, the dog that didn't bark kind of thing. You can sit there and worry about the disruption. The disruption is also, it's so much harder now for somebody else to take ServiceNow or Salesforce's business because Salesforce is doing it better. So for them to be replaced is now that much harder.
Well, let's use Salesforce as an example. Kind of the concern is that any Joe Schmo can go on a computer on Claude and build their own CRM, code it up. Maybe even a non-programmer, can code up their own software and build up their own CRM. So it's going to increase competition in some ways in the software space. But those with deep pockets can grow quicker and innovate quicker. So they have billions and billions of dollars to spend on innovation, and they also can hire tons of people in-house to do it themselves inside to grow their own software, and they're going to stay ahead in a lot of ways. So, I'll use this as another example. My grandfather, I remember sitting on his lap. I was probably 4 years old, and he was just amazed at how many things I could do on my computer. He had no understanding of how computers worked or how the internet worked. He's probably in his 70s at the time. AI adoption, even though businesses are using it, not everybody is using it on a day-to-day basis. And it's going to take decades probably for people to really learn how to use AI by their side in their jobs, in their everyday life. And it's going to, especially maybe the older generations in some ways won't adopt it. So my point is, it's going to take a long time for really people to adopt this, and those with deep pockets are going to stay ahead in a lot of ways.
Great. And we are all out of time for today. I'd like to thank Luke and Colin for sharing, and thank you all for joining us for this live session. We have more presentations throughout the day, and the next session begins at 11:50.
Thank you, Madison. Thanks for tuning in, everyone. I appreciate it.
Thank you.